Hey, what's going on, everybody? Good morning or afternoon, depending on where you are. It's about 1 o'clock over here in Georgia on the East Coast. I just want to talk a little bit about, some stuff I'm coming out with. This is not wine. This is actually pre-workout. I just like the wine glass better. I'm gonna get ready to do my workout soon. So a couple things. So I'm coming out with some training materials and some worksheets. And I am offering my training services to people who want to, let me see if I can fix this real quick, people who want to further their knowledge in, trading, stocks or options or even cryptocurrency, to be honest with you. I've had my hands in this stuff for a couple years now, and I've got a couple patterns that I like to trade based on research. The question I get asked a lot is like, hey, how do you know all this stuff? Did you learn something from a class, or did you go to school for this? I don't know that you can go to school for investing. I'm sure there is training programs like such. What I will say is I did go to one class. I'm not going to say the name of the company just because I don't want to infringe on any negative territory or whatever. So I drew up you guys a chart, and this is going to show one of the basic patterns that I trade. And it's kind of obvious, really, what it is. So the second company I'm coming out with is going to be the Fishhook Stock Trader. I got to get confirmation on the name that I'm able to use it. Nobody else has it. But that is precisely what I trade. That is one of the patterns that I've used quite a few times now, and it is very consistent, as you can see. If you don't see a J or a hook in this chart right here, then maybe learn the alphabet again. Doesn't matter if it's uppercase or lowercase. So here we go. This is an example of Ford stock, Ford Motor Company. Right now, they're sitting down in this range. If you can't read that, it's $9.37 a share, give or take. This is about a month. This is a 1 month chart. This is back in August. Not August. It is in August. Let me see. Give me 1 second. I got the computer right here. I'll leave this so you can look at it. My little eyeballs there. All right, let's see. Let's go to Ford. Got my laptop right here. I need to get me a new trade set up so I can have some monitors going on, and I'll definitely get an image for you guys on that. All right, so 1 month chart, currently at $9.36 per share, and it's making a nice flat line across the chart now. So this line is consistently coming sideways, which generally means the market cap is loading up a lot of times. But right now there's a lot of turmoil in the auto industry for some reason. All these people talking about the economy dropping hard, and market corrections and all this stuff. So people are being very skeptical on what they're trading. They're either holding long, and if you look at the the ratings like Reuters and things like that, there's actually a very consistent hold pattern. Buy rate is about 23%, hold is like 70%, and then sell off is like 12% or whatever. So anyway, what I want to show you, so yeah, August 28th is actually this high point right here. So what I'm saying is, and this is like a kind of a day trade slash thing. Now I'm not saying you're day trading. Now if you have a cash account and you have money to flow, you don't have to worry about pattern day trading. So PDT rule, if you ever heard that before, it means pattern day trading. So basically anytime you trade more than 4 consecutive times in one business week of trading, so 5 days, you'll get marked as a pattern day trader if you're in a margin account. If you're in a cash account, that doesn't apply. Now, what happens in a cash account, of course, they have to have some stipulation for you, is that if you do violate the good faith violation, which is basically selling something that you just bought that has not settled yet, and a lot of different stocks have different time sets for those things. So something may settle in one business day, something may take 2 or 3 or 4 days. I've had stocks that I've had on here, especially when it's a very large amount of shares. Say you're trading penny stocks or something in that range, and you have tens of thousands of shares. You might not be able to sell and settle everything in 1 or 2 days. So what happens is, if you use that money to buy something else and then you sell that within a day, chances are you're going to get hit with a good faith violation. I've only received 1 letter from that, and that was last year when I wasn't really paying attention to how frequently I was trading the same thing. And I did get hit with a good faith violation just because back then I was only trading like $2,000. Now I got my account up to around 6,000. I actually monitor my own 401k and all that too. So right now the market is very sketchy with Trump doing all his stuff, and overseas in the Asian market, lots of different things are happening. But anyway, back to the point. So we call this a fish hook pattern. Why? Well, it's very clear. So you have a high point, and then you have a sudden oversell or standoff, is what I call it. So basically, you have people saying, "Oh man, we got a rocket ship going," and then all of a sudden we're going to the moon, and next thing you know, it falls. So if you bought up here at 986, you're pretty mad that you are now down to 963. So yeah, that's only 20 cents. Oh, okay, well if you have 100 shares, you multiply that out times 100. So 20 cents times 100, I mean, you can already get where we're going here. So that's going to be $200. I'm sorry, $20. So anyway, so if you had 1,000 shares, then yeah, that's your math. Anyway, so what we're watching for is a very high peak, and then all of a sudden, pew, we got this long drop over here. Draw a little picture. I took advantage of this, and I took advantage of this. This is actually my current position. I bought right in this range. It was like 942, I think what it was. I bought 200 shares. I've hence sold recently just to get out of the position because I want to make sure that this is going to stay consistent and then come back up. So all we're looking for is a little bump right here, even if it only goes back to like 950 or so. I actually have a lot of options contracts on this, and I'm actually projecting them to become worth a lot more than what I paid for them. 2 cents or $2 per contract, and I have quite a few. So what you're looking at, you can probably actually get those same ones for about a penny right now, so per contract, which is $1. I trade options on Fidelity and on Robinhood. I also have Webull. The thing I like about Robinhood and Webull is it gives someone an opportunity that has never traded before to get free stock just for signing up. I'll put that link in the description. I'm sure you've seen it a million times. Nobody says why. You just see it and you're like, man, this guy just wants me to sign up so he can make money. True, but at the same time, you're making money. Matter of fact, my wife's sister, she was doubting it. She was like, I don't want this. I don't know what it is, blah, blah, blah. So she eventually signed up, and she ended up walking away with $4. So she closed the account. She didn't want to trade. She decided against it. That's fine. I showed her how to sell the shares, okay? And once she sold it and it settled, she cashed out the $4.03. So the stock was worth like almost $5 when it gave it to her. And since then, the market, has done a slight downturn, and then it was like $4. So she basically got $4 for free just by signing up. Now, if she changed her mind, the account's still there. She didn't close the account. She just, deleted it, uninstalled it from the phone. So what we're looking at here is a consistent pattern, and there's another one I'll show you in a moment. Lev B here. That's one of my favorite ones to trade in the last month. So basically, when you see this huge drop, you want to buy down here primarily when it starts to curve. So somewhere in this range is where you want to buy. So the current low, this is actually the lowest in the last 5 years for Ford, so 927. I don't think it's specifically Ford that's caused this. I think it's the market in general, and it just so happens to be right now that all this is happening. So a lot of people buy cars at the end of the year, the beginning of the year, tax time, and all those things. There's no doubt in my mind that this will not get back up in this, $10 to $12 range, pretty soon, at least within the next 3 or 4 months. If I'm wrong, hey, it's not financial advice, so don't take it that way. I'm simply showing you one of the things that I am actually writing several ebooks on, and also I'm going to have trade worksheets and things like that. So if you do purchase my trading materials, you'll actually be endowed to understand this a little better. There's other things, other variables that go into this, but primarily it is literally almost as easy as looking here. Oh crap, oversell for some reason. Maybe the big fish are like, hey, we don't want to hold Ford right now. They didn't do something we like, or we think they're going to go out of the country with Trump's whole thing and developing certain cars or overdeveloping certain cars, and that's what happened. The whole Ford F-150 recall thing, not that big of a deal. It's a seatbelt fix and something with possible fire hazard. And when people see that, they're like, oh my God, it's going to burn down? Well, they did have an issue with the older F-150s a couple years ago that was actually doing that. And the aluminum body, when heat hits aluminum, it goes pretty quick. It's not as strong as steel and things like that that'll hold up, even under fire. You can almost save the frame to some cars in that case. So what we're looking at here, it's very simple to understand. You look for the dive, which is we call oversell, and most likely it is either market speculation, or the recall factor. That's why it did this. It went from 10 to 9. I actually, like I said, I picked it up at the 9.40 range here, sold it back just to make a tiny loss. I mean, 200 shares, I only lost like $15. I mean, it's not really that big of a deal. If $15 is going to hurt you, don't trade. Like I said, I utilize in my 401k and my personal trade account. I'm watching forward right now on my computer. It's moving in between the 930 to 938 range. It's slowly making its uptrend right now, so it's starting to do this. It's at 938 now, and on the 1 month chart, it looks kind of dramatic. When you go to a 3 month or a 1 year or 5 year, the chart is very, very bland. But what you want to see is consistent up and down, because that's how you're going to be able to take advantage of this. If you see something that's doing this, that's not something you want to try to trade a fish hook pattern on. That's something you're going to want a consistent return. Now, if it's slowly, sorry, you can't see that. So if it's slowly going like, yay, wee, and then drops off and then does this again, this is likely speculation. Okay, the only reason a stock would jump like that is due to speculation. Cannabis stocks, there's one I was looking at a minute ago, Tilray. That sucker was $20 a share in August. It is now $123 a share. You would have multiplied your money 5 times if you would have bought that a month ago. I sadly did not get that and did not get to take advantage of that. I wish I could have. That would have been amazing. So it's the only cannabis stock that is really progressing right now. That I guess they have their hands in a lot of pockets. Or they got some big dogs behind them that are really pushing that stock up. So $123 a share versus $20 a share just literally a month ago. That's insane. That is returns like Amazon would bring you, when it first started really getting big, with Bezos saying, hey, look, I'm not just going to be a bookstore, I'm going to run the world eventually. And that's what it seems like. Anyway, so let me go ahead and actually erase this, and I will put Lev B, my other favorite stock, to trade currently. And I've done this consistently on my personal and my 401k account. Let me pull this chart up real quick, and I will draw this out and show you the very, very simple trade pattern that I've been doing consistently. And it just did it again. Matter of fact, so I'm waiting on it to come down a little more than what it is. It's consolidating out to the side. We're going to wait till it drops a little further than that. So we have, let me draw this up for you guys. And if you want, you can totally go look online. I'm looking at Robinhood right now, but you can see this in practically any chart. So it's making its turn. So let's see. I took advantage of this both times it hit this rocket ship over here. Let me go. Got me a new mouse that's like clicking away over here. So that's a nice big gain. So the next gain is going to be probably much larger than the last two. The consistency and current price. There we go. All right. Sorry about that. Now, can you see the J? I'm not exaggerating this. This is literally on my screen right now. Level Brands Incorporated. Lev B is the indicator. It's traded on the common stock. So check this out. 375 I saw. I noticed it hit way down here, and I picked this sucker up for not 298. I picked it up for twice actually. I picked it up at 289. All right down there at that bottom. And then I also picked it up. I'll just confirm that that's correct, because I hit it, 289. That was a dead low. And the reason I found that is because I went back to the year-long chart, and I saw, the 3-month chart, and I saw the lowest it had been was 277. And I was like, all right, let me check out a year. Oh, wait. In 2017 of November, it was at $5 a share. It got back to $5.40 a share just in April of this year. And like I said, the all-time low it tagged was 277. So I was like, all right, I think it's a pretty good, comfortable position for me to buy at around 280 something. So I went ahead and put 289. Like I said, that's where I got it right here. I'm trying to make sure I don't run out of recording time, so I keep looking. So when it jumped back to, 317, so I sold it here once. it dropped again. And this is in my personal Robinhood account I've been trading in. Yep, 298. That's where I bought it the other time. So I got it at 298 down here. I had a limit order much lower than that because I figured it would go back to 280 something, but it didn't. It stopped at 298. And then I ended up selling right here, which was 340. No, that's 365 is that one crest. So yeah, 340 something. Yeah, so this is 365. I sold like right in here at 345, and that's where I took my profit. So you're talking about $2.98 to $3.45 a share, and I had several hundred of those, so I made a nice little return. Yes, it did continue to rise, and it went to 382. That's okay. I'm okay with taking a nice profit there. That's not something that I'm going to worry about. Oh man, it went up to 382. I missed out on 40 extra cents per share. Yeah, that would have been a nice extra return, but that's not what you want. You want consistency. If you would have rode this wave here and you got happy and you're like, oh my God, it's going to go to $5 again, and then it did this, what happened? You just went back to $3.35 a share. Now, if you bought it over here, that wouldn't be an issue. But why would you wait to do this just to fall back down again? So right now we're taking advantage of another J format, and it's already making its turn back up. So it's at 335 right now, and it's consistently, let's see, 332. Okay, so 332 is where we're chilling at right now. The lowest it hit was 310. I picked it up at 315. I sold it at what did I sell it at? 320 something, just because I didn't know how long it was going to be before it jumped again. So I've traded this in and out several times just in the last month. So you can see that, like I said, this 1 month chart, we're looking at 375 peak, 382 peak, and if you go back even farther, let's go back to the 3 month again and see how many more peaks there are. And you can trade the short term, the small triangle I had on there, you can trade that one as well. So yeah, we got a big peak way back here at on June 22nd from 430. Remember, it was at $5 again back in April. So in June, it was at 430. It dove down to 370, and then it had a consistent drop all the way down to 277. Now, when it hit that resistance point, which you can see on different chart patterns, you know, you can get on Fidelity and then go to indicators and go to settings. You can draw your mountains, your open, high, and low. See, I like bar charts, but I like this mountain better because I can actually see this. And in a bar chart, it's very difficult to see where, you know, besides when the bars start getting smaller. So you got green bars and they start getting smaller, it's probably about to turn down. You got red bars getting smaller, they're probably about to turn up. So that's referencing a bull market coming and or a bear market coming on the ladder. So yeah, basically, I mean, it's very simple to see these patterns. I mean, you have to look at a stock's consistent return. Like I said, this is what we're looking for. I have a limit buy at, what I put it at? I think I put it at 315 to limit buy 600 shares, right? And once it takes that order, I'm going to watch it for a day, see what happens, and I'm going to wait. And as soon as it goes this way again, I'm selling up here. Now, some people will say, hey, as soon as you make this turn, you buy and you sell. You don't wait for the possibility for it to do this. You get out here. Now, the reason being is because if all of a sudden it downturns again, you're gonna be hurting because you're gonna lose. Market dead. You're gonna lose a good amount of money if you bought it even at 289 and it just drops to 277. Say that was that last 52-week low. Sorry. So 52-week low was at 277, right? And you bought it at 289. Even at that most recent last 3 month down, you're going to be hurting if it goes back to 277, depending on how many shares you bought. Now, if you bought 50 shares, it's not really going to hurt you much. It'll be a few dollars here and there. But 277, now say it jumps back up to 315, you might just jump out of the position just to be safe. I'm not saying, you know, there's a saying apparently that a lot of people will actually say, and it's cut your losses short and let your winners run. Well, yeah, if you knew the stock was going to do this, why would you cash out anywhere here? Why not just wait until it got to 382 and somehow you know and you have the inclination to know that 382 is the top. And then you're going to sell because it's going to make this big old dive. Well, if that was the case, you'd be filthy rich already. And some people, you know, they may know that kind of thing. Or they may follow bar charts so closely that they can almost guarantee themselves they're going to be up in this range. Now, if I would have sold 365, more happy, 20 more cent per share. So that's a big little jump for a small account. But if you're looking at 10,000 shares, that's a huge difference because for 10,000 shares, 10,000 shares, every penny is $100. And if this thing's jumping 20 cent, that's huge. Okay, so every 100,000 shares is $1,000 per penny. And that's something I like to follow because it's very easy math in your head. If you got 3,000 or 10,000 or 50,000 shares, you know exactly how much you're going to go based on the 100,000 share mark. If 100,000 shares and you got a penny movement up or down, that's $1,000. Now that can make your account look real scary sometimes if it's like, oh man, it went from. Now most of the time you see that in penny stocks, like real penny stocks, like less than 10 cent per share, and you have something that moved 0.002 cent. And you just lost $800, on nothing. And you're like, oh my God, what just happened? But then you realize you put several $1,000s into those shares, and it kind of makes sense. Anyway, so before this chart gets all blurry, LevB, and these are not investment recommendations or financial advice, et cetera, et cetera. You always got to throw that disclaimer because some person out there is going to be like, well, that guy told me to buy this. No, I'm not telling you to buy anything. I'm just simply showing you what I've been trading consistently from marks like this. That was definitely an oversold. Sorry, my handwriting's a little sloppy. I'm writing sideways over here. Oversold down to 289. And because the stock was actually, if you looked on all the ratings companies, with that specific stock on several websites, you would see that all of them saying it's a strong buy. Majority of people follow those ratings without caring about speculation. They don't care about anything else. They simply go off of what Reuters or any of these other ones are saying. I keep saying Reuters is the first one in my head. But anyway, so 289 to 317, that's a nice markup. 317 to 382, if you got anywhere in that range, then you're great. But like I said, you always want to buy that dip. You always want to buy that dip. You don't want to wait until it starts going up again to buy, because guess what? If it's like, oh no, we're going back down, well, you just bought high. Why would you buy high? Wait until you see the turn. When you see the consistent, it dropped off, and you see this happening, this is where you want to buy, somewhere in this range. And then when it starts doing this, one of two things are going to happen. It's going to continue to go up, or it's going to flatline and go back down. Now, if you sold here because you saw it turning, even if it's a temporary turn, some of these charts, daily or intraday charts, you'll see it like fluctuating very consistently sideways and up and down. But you have to realize that you're looking at an intraday chart. And if you're looking at something that's like a 1 or 5 minute change, you're going to see some dramatic movements. Whereas you went out to a 1 week chart, it's going to be like this. And chances are, okay, well, depending on how far of a difference this is, this could be, 10 cent up, 10 cent down, 10 cent up. And that's a lot. If you have, like I said, if you got 100 shares, you're looking at every penny movement is like $10 or $1. What's $1? 1,000 is 10. Okay. My math's getting a little crazy over here. I'm not a math expert. It's been a while. I've been out of school for quite some time, so none of this stuff's fresh in my head. My youngest is in school now. Not my oldest son is in school now, and they got this new Common Core math garbage. So we're gonna see about that. So I read several things about it. So one is either that they can discover very intelligent students. This is where they can just adapt to this new math with no issues, or maybe not, and it's just a complete crock of crap because we've been taught something for a long time a different way. So right now, LevB is still at 332. I have that limit buy. Probably got auto logged out of my account over here because I haven't touched it. So let's see where we're at real quick. If LevB is at 332, I still have this limit buy. So it only needs to turn down one more time. So it's making this nice consistent line, and it's kind of trending up. If it drops again, 315, anywhere in this range, I'm going to buy it. Now, if it dives past 315, obviously my order is going to get picked up, but I'm going to wait. I'm going to give it at least a week max to find out if it's going to turn up like it's supposed to, according to the chart I'm reading and following. I'm going to go back to the candlesticks. I'm going to confirm the candlesticks. Okay, are these green bars getting smaller, or are the green bars getting bigger? The green bars getting bigger. There's a Japanese candle pattern. It's 3 green candles, and when they're going up, you got a higher high and a higher low. It's actually going to start inclining the price, and people are going to see those 3 bars and they're going to jump on it. And what's going to happen then is it's going to spike. Now, when it spikes, I'm getting out. You know what I'm saying? I'm going to buy down here at 315. As soon as it goes back up here, I don't care if it's 320, 340, 360, or 380. I'm cashing out because I'm taking profit. I'm scalping the market. I'm hedging a stock with a gain. So most of my percentage, do I have rules? Yes, I have certain rules. Don't trade on emotion. You hear that a million times, but it's very true. If you see red and you want to get out, chances are you're just throwing money away, because if you would have waited 10 more minutes, like a stock, I was looking at Ford options I did, and Ford has consistently made me money on stock options. I love options. I've used this same pattern in the chart I have a while ago with Ford. Get that out of there because it's getting very messy over here. Let me go ahead and erase all this. Now what I'm saying is I have some the stock option I was trading. Like I said, it was Ford, and Ford was doing up and downs again. And so I bought in at, I just did 3 out of nowhere. I did 3 at 10 cents. So that's 3 contracts. Let me actually write this straight so you folks can read it. So 3 contracts. If you don't know about options, my training materials and my ebooks are going to explain contracts very simply for options. 3 contracts at literally 10 cents times 100 shares. All right, you always do it by 100 in contracts because that's what it is. I don't know why I put that there. So 10 cents per contract times 100 shares is $10. All right, so you got $10 that you're paying. 3 contracts times 10, $30. I put in 30. What was it? 10 minutes later, it went up to 18 cents and times 100. And now I've got 40. What was that? $45 roughly, $48. So 1800. $1.80. Yeah. Anyway, so 40 whatever. I can't remember the number. Like I said, I'm not great at math. So if you math geniuses, this should be really easy. So anyway, so I sold it at 45 plus. Just in a matter of, I think it was like 10 minutes or so, that the Ford stock price shot from like $9.50 up to like almost $10. And this price shot up, matter of fact, 15, 20 minutes after that, this sucker was over here at $1.25. That is $125 per contract. That would have been $375 in my pocket. But my impatience cost me some money. But at the same time, when Ford dropped off again, because the expiration, which is another important thing of options, the expiration was actually 2 days from then. What happened was there was a huge spike on the stock for people cashing out. All right, people were buying shares, manipulating the market, whatever the case was for Ford stock to spike like it did, causing these options to become worth so much more than what you paid for them in the beginning, on the incline that you knew or thought or felt very strongly that that stock was going to go up. That's what you're looking for. You're not looking for, if you want consistent returns, I would recommend selling puts against stocks that you think are going to go down, because what's going to happen is, or if somebody is already holding the stock, the options contract house is going to match you with somebody else. So say, I feel like the stock's going to stay stable or go up, and this person over here has 1,000 shares or 100 shares, and they're scared and they think it's going to go down, so they want to hedge their loss, and they're going to sell a put. All right, I know I'm talking about a lot of things here, but bear with me. Anybody that watches this video, thank you. Sorry, I'm going to get better at this over time, and have somebody maybe record me or whatever. So sell a put and edit the video. So sell a put of 1 contract. Let's just say you only got $100. All right, you got $100 to spend, and that's it. So say there's a stock over here at, I hope you all see this, at $1.18 a share. And recently it's been doing this, and this person holding 100 shares. So there's, okay, put it this way. So there'd be a put. You're going to sell a put for $1. All right. You're going to sell it. So if you sell that put for $1, that means what? That means you are putting yourself up in your $100 collateral that you have, and you want to sell this put for $15 to $25. All right, so that means this guy holding 100 shares at $1.18 a share is going to pay between $15 to $25 if they accept your contract, if they're willing to buy it, and the options house matches you or whatever. And say you put $15 to $20, say you put $20. So this person is going to pay you we'll just say 25, keep it simple. This person's going to pay you $25 premium to hold the right for them to sell you those 100 shares at $1 each. So they cut their losses. Say the stock dove to 95 cents or 85 cents. You would get the stock discounted, assuming it's going to go back up, because you figured it was going to go up anyway. But in the event that it does, the contract is exercised, which means it's acted against you to buy those shares. So now you bought 100 shares at $1. So you spent your $100 on, let's just say FCell. That's a fuel cell, alternate fuel energy company. And what happens is you got the $25 anyway, right? So depending on how far that stock went down, now if it turned around and shot right back up to $1.18 or $1.20, not only did you make $25 premium, you also made everything over the $1 a share that you just bought for 85 to 95 cents, right? And they got scared that, oh man, I didn't lose that money. So, but they paid you. Now, depending on, this may make sense to some people, may not. So 18 cents per share times 100, you're going to get on up there in money. But if it only cost you $25, say you were going to lose 50, and if it went down below $1, because say you bought it at $1.10, and it went up, you're I'm making money, but I'm scared it's going to go back down. It falls below $1, you would have just lost a lot more. But say you're going to lose $50, hey, I'm going to pay this guy $25, and I'm going to save all my money and $25. Whereas if I let it go down and I have to sell it because I'm scared or cut my losses or whatever the case, or the stock's just tanking and they put a stop loss in there, then they're going to save that extra 25 where they paid you 25 to hold that position for them to be able to get rid and unload these 100 shares for you, and then you turn around, keep it, hold it, sell it. If you it could be something like Amazon back in the day. Per se, I'm using an example because it blew up. So if FCell decided, hey, we're doing this, we're merging with this company, and then our stock price should go through the roof, and it does on speculation, guess what's going to happen? That discounted stock, because you'll hear that, hey, how do you buy a stock you want at a discount? That's how you do it. Selling a put, and then somebody exercises that contract, and you'll break even down to somewhere in this range if you're doing it here. I think 92 to 95 cents will break even on $1 on 100 shares. So because you already made, for this 25, this is actually probably going to be 85 cents, because what you do is you take the difference that you got paid premium, the price you had to pay, and subtract that, and that's actually your break-even point. So it can actually fall even farther because you got a higher premium. Now, I've literally done this on this stock for the $1 mark because it was at $1, and I looked at the last 3 years, and it has not been below that. And even when it did, it only went down to I think it was 87 or 89 cents. So I'm not scared that the stock was going to go down. So I put up my $100 collateral, all right, for 100 shares, and I'm going to pay $1 per share. I know it's getting blurry over here because there's so much crap, and that's fine because I'm pretty confident that this stock, if anything, is going to go up. Now it's